Next, I'd like to welcome Fran Seegull, the Executive Director of the U.S. Impact Investing Alliance.
Thank you. Good morning. It's a tall task to follow subject matter experts and the rhetorically gifted, a panel of 4 rabbis and the unofficial rabbi of impact investing, Sir Ronald Cohen. Julie Hammerman gave me another tall task to make the case for impact investing, pardon me, in just 10 minutes. So forgive me for being a Seinfeld-esque fast talker. Religious and secular references together. So good morning. I'm Fran Seegull, the Executive Director of the U.S. Impact Investing Alliance. The Alliance is a field-building organization dedicated to transforming finance by placing measurable social and environmental impact alongside risk and return in investment decision-making. I'm here to convince you that this vision is not only attainable, but that we're already well on the way to making it a reality. I am confident that the future of investing is impact investing for one simple reason: the world is changing. And with it, investors must revisit how they assess long-term value. This change creates both challenges and opportunities. Global population growth is straining natural and man-made systems alike. Pressure to steward dwindling natural resources will grow, while a changing climate threatens lives and businesses. At the same time, consumer demand continues to rise, but the contours are changing. Increasing inequality in the West is coupled with ascendant middle classes in China and India and elsewhere. These factors present new opportunities for firms able to navigate in choppy seas and new markets. As investors, we need to demand that businesses prepare for and adapt to these eventualities. We can already see the effect of change on the capital markets. Even in the relative short term, unsustainable business practices can have disastrous consequences for investors. Take the Volkswagen emissions scandal. The company's stock price fell 40%, wiping out $30 billion in market cap. In addition, Volkswagen received a $2.8 billion fine, and for 18 months, the company was unable to tap the bond markets to raise capital. Recently, Norway's $1 trillion sovereign wealth fund indicated their intent to cut oil from their holdings. This reflects expectations of declining productivity, increased volatility, and stranded assets, which is a point you made earlier. And as I mentioned earlier, changing consumer preferences are driving investment outcomes. Take Uber, for example. Here we have a hugely successful startup, now perhaps on track to a massive IPO, but a toxic corporate culture has threatened to drive away consumers, and indeed has driven away consumers. As boardroom drama plays out in the public spotlight, Uber experienced a down round with SoftBank at a $30 billion off-peak valuation. By contrast, we see increasing popularity of impact enterprises, both private and public. For example, B Corps are becoming mainstream. Natura of Brazil was the first public company to receive B Corp certification, and Natura recently acquired Impact Pioneer and B Corp The Body Shop. Ben & Jerry's is a B Corp division of Unilever, which recently also acquired Seventh Generation. Changing consumer preferences are mapping with changing investor preferences to accelerate the impact investing movement. The same customers who are abandoning Uber are also asking tough questions of their wealth advisors. This matters because we're in the midst of a $40 trillion wealth transfer to women and millennials. A survey from U.S. Trust found that 2/3 of women and 3/4 of millennials are interested in investing in alignment with their social and environmental values. Mainstream financial firms are waking up to this fact and responding to client demand. Blue-chip wealth platforms like Morgan Stanley, Goldman Sachs, and Bank of America Merrill Lynch, and incumbent asset managers like TPG, BlackRock, and Bain Capital are increasingly embracing impact investing. This year, when 62% of shareholders of ExxonMobil voted for the company to disclose balance sheet risks of a 2% Celsius rise in temperature, it was the support of BlackRock, Vanguard, and other large asset managers that put it over the top. That said, there's still a touch of condescension when mainstream outlets report on strong returns in impact investing. But there's increasingly hard data to back up the trends. Across asset classes, whether you're investing in public equities or private deals, whether you're looking at the next disruptive technology or just where you keep your savings account, it is possible to have impact and generate competitive financial returns. Here you can see some of the findings from a meta-study by Oxford University and Arabesque Partners that analyzed over 200 primary studies. They found that ESG performance correlates to financial performance, and I'm thinking Joel, who we'll hear from in a moment, is that correlation does not equal causation, but still, ESG performance correlates to financial performance, and they track this to a few specific factors. Firms with better ESG performance have a lower cost of capital when they borrow money and issue bonds. This is dramatically illustrated by the chart on the left, where you see the 10-year credit spreads for various oil companies. In other words, the cost to insure the debt. That blue spike is British Petroleum, and you can see that even long after the Gulf spill, the market is placing a higher premium on their risk. Firms stronger on ESG factors enjoy better employee satisfaction, driving lower staff turnover. Diverse leadership keeps costs down and tends to lead to better decision-making. And perhaps most importantly, studies consistently find that ESG performance correlates to lower volatility of stock price. So let's look at the private side, the private capital markets. The impact investing benchmark developed by Cambridge Associates and the Global Impact Investing Network, the GIN, analyzed market rate impact venture capital fund returns from 1998 to 2010. Impact funds matched the incumbent venture capital benchmark and even at times outperformed, especially in emerging markets for smaller funds. Of course, these market rate studies don't describe every impact investment. In truth, impact investing exists across a spectrum of financial returns and impact. This slide attempts to show this fact, and that for some, impact investing will be an extension of philanthropy, offering high impact with concessionary rates of financial returns by design. We don't want to lose sight of this because we know there are some instances where a market rate of return just isn't realistic. When you are working in the most difficult contexts, certain geographies, serving certain customer segments, a subsidy may be required. However, we also have instances where well-placed early subsidy has helped to create mature markets. The classic example is microfinance, which started in the mid-70s very much as a philanthropically motivated investment. Folks at the bottom of the pyramid were viewed entirely as too risky to lend to. But after 20 years and $1 billion of the so-called subsidy, philanthropic subsidy, microfinance is established as an institutional investment option. There are individual deals that straddle these lines too. That's where you'll find a lot of the most innovative products, including social impact bonds and blended finance. I mentioned at the start that we're seeing a new rush of money into impact investing, but just how big is the market? The U.S. Sustainable Investment Forum has been conducting a biennial survey since 1998. They measure mainly negative screens, shareholder activism, and ESG, environmental, social, and governance investing, with some community investment in the number as well. In 1996, the survey sized this market at $600 billion. Today, it is $8.7 trillion, or 1 of every 5 investment dollars in the United States. In 1996, this was mostly institutional investors, but we see today is growth among mid-sized and even retail investors as new products and strategies are democratizing access to impact investing. Another measure of the impact investing market, the private markets, is from the Global Impact Investing Network, the GIN. These are direct investments in firms and funds with a clear impact focus. This measure of so-called deep impact investing found $114 billion in assets globally. So this is the context that brings us together today, and this is the context in which the U.S. Impact Investing Alliance operates. As I said earlier, the Alliance is a field-building organization dedicated to advancing impact investing in the United States. The Alliance is being incubated by the Ford Foundation, and our board is led by Darren Walker. We approach this work with a three-pillar strategy, actually not dissimilar from the strategy of JLens itself. The first pillar is policy, seeking to create an enabling policy environment at the federal level for impact investing. Here, a predecessor organization was the U.S. National Advisory Board, which advanced a number of key policy accomplishments. These included modernized rules of fiduciary duty for foundations and ERISA-regulated pension funds, as well as a growing interest in social impact bonds as a way to align public dollars with impact and potentially attract private investments. The 2016 election presented an unexpected set of challenges for everyone involved in policy, indeed everyone. And impact investing was no different. However, we took the position that impact investing has appeal across the political spectrum, and we are encouraged by the progress so far. The Alliance held the first ever Senate roundtable on impact investing in October. Our second pillar, we seek to catalyze the flow of institutional capital to impact investing, and there we run the U.S. It's a U.S.-based organization, Foundation President's Council on Impact Investing. It's a group of 20 leading U.S. foundation presidents committed to impact investing through their endowments. We're also engaging donor-advised funds and pension funds. And finally, we engage in movement building. We are the U.S. representative to the Global Steering Group on Impact Investing, the successor organization to the G7 Social Impact Investment Task Force, which Sir Ronald Cohen chairs and is dedicated to building the impact investing movement globally. The group used to have the G7 countries and now has 16 countries. And this summer, we had a summit, a global steering group summit in Chicago, and attracted over 500 delegates from over 43 countries. So the point there is the impact investing movement is a global one. Through these efforts, we believe that we can empower every investor to be an impact investor. When I launched the U.S. Impact Investing Alliance with our board chair, Darren Walker, again, president of the Ford Foundation, we did so with a simple message. The future of investing is impact investing. It is a message inspired by our vision to help to place, again, measurable social and environmental impact alongside risk and return in every investment decision. I am inspired and motivated by this vision. We can all see the tremendous scale of the problems before us: income inequality, lack of access to good jobs, food and water insecurity, health and education issues, and of course, climate change. But against those challenges, impact investing offers an opportunity for each and every one of us to be part of the solution every day. So I hope you will join me in aligning our values with our investments to create the world that we want to pass on to our children and our grandchildren. Thank you.